will be gone. So welcome everyone to today's lecture in financial risk management. We talked a lot about backtesting and stress testing last week, and we will now continue our discussion of risk management with a focus on the valuation of linear assets and then later on derivatives. And if you were to pick up a textbook on risk management, you would see that actually most the major parts of most textbooks on financial risk management are actually devoted to financial derivatives. And in some cases, those textbooks are just 100% about derivatives. Why is that? In many instances in financial risk management, you can only do what? You can see that you have a risk exposure. You cannot reduce the risk exposure anymore. You cannot eliminate the risk. Why? Because you want to take the risk. You are interested in investing in this risk, but you want to hedge yourself. And then you need a hedging strategy, and hedging usually requires a counterpart to your trade, and this is usually a financial derivative. We will see what financial derivatives are traded on markets, and we'll see what a financial derivative is, of course, and what types there are, and then devote a large part of the remaining lecture on the Black-Scholes-Merton model and option pricing, and switch to selected hedging strategies in between, because after we have discussed a certain derivative, we'll talk about how this derivative can be used for hedging. But let's first start with valuing simple linear assets. And we'll see that even by starting with linear assets, we can come up with some strategies and some investment and hedging strategies that could actually work. So we are here now at 6.1 and some very simple linear assets. You might have seen this before in Professor Schumacher's investment class. These investments 1 and investments 2 also deal with selected financial assets and how they can be priced. And we'll just present some nuggets from those results here. Needless to say that, well, if you want to look this up, you can take this book by Hans-Peter Deutsch. Needless to say that the defining element here is that these are all financial assets that have a price that linear depends on the risk factors. So in many cases, it's very simple. For example, take equities, take stocks. With an equity investment, you simply take a stock, you assume that the stock price is the only relevant risk factor here, and then it follows quite easily and quite simply that, of course, the risk exposure and the loss distribution of this equity investment linear depends on the stock price. It's actually almost identical to the stock price. But this is just the starting point. As we progress to more complex financial assets, we'll see that more risk factors come into play, and also the nature of the relation between the risk factors and the profit and loss distribution becomes at some point non-linear. Most notably, of course, with financial derivatives and options. But here, with equity investments, this is very simple. Now, stocks, as you are all pretty aware of, I believe, are financial instruments that securitize participation rights in a joint stock company. In Germany, we have nominal value shares, and Nennwertaktien. They divide the share capital of the company into a certain number of shares with a fixed notional value. And by acquiring a share, you become a part owner in this company, and you have the right, for example, to receive a dividend. You have voting rights, and of course you have limited liability, because if the company defaults, you don't have to pay up more money than you've already invested by buying and by acquiring the stock. So that's pretty simple. You have voting rights at the annual general meeting. You're entitled to a share in the company's profits in the form of dividends. You have a subscription right for new shares in a seasoned offering. And in case the company is liquidated, which happens quite seldomly, I guess, you are entitled to a share, to a part of the liquidation proceeds. However, usually you are just in for the resale price of the stock and the dividends, of course. This listing shows that you have various rights as a stock owner. However, for valuation purposes, usually you will just restrict yourself to dividends and reselling the stock, and dividends should also be reflected in the stock price. So after some deliberations, you will see that the stock price is the only relevant risk factor here for this equity investment. So you have price, dividend payments, especially if you're a short-term investor, the dividend payments can be neglected so that only the price of the security is relevant. Theoretically, the fair price, the value of an investment into stocks results from the present value of all future payments, and that is quite simple. You simply take the sum of the discounted dividends, D1, D2, plus and so on, plus D infinity, all discounted, and so on. And of course here you also have the resale price at the end. Now, a simple observation is here in place, and it should be made here. If you look at this valuation formula, you will see that if you take the terminal price of the stock at infinity, you are discounting it over an infinite number of periods, and thus this here actually should become zero. So you, as a long-term investor, you should neglect it. And what you see is that today's price of the stock should just reflect the discounted present value, the present value of all future dividend payments. It's quite simple. So it's a perpetual annuity of the dividend payments, and this is one way to do it theoretically. However, you can just see that dividend payments should matter the most. You could then, if you think this is too theoretical, you can try to forecast tomorrow's or next month's stock price. This is more difficult, I guess, from a statistical point of view. From an economically point of view, it's maybe easier because it's easier to predict a future stock price than to predict each and every year's dividend payments, because these depend on the company's profits. You could also use factor models, like for example the capital asset pricing model, Pharma French 3-factor model, Pharma French Carhart 4-factor model, and explain the cross-section of stock returns and thus the prices of the stocks by using macroeconomic or idiosyncratic variables, like for example market return, the size factor, the momentum factor, etc. So these are some possibilities to forecast those prices. Note, however, the fundamental difference between these two approaches: present value on the one hand and a factor modeling or a direct modeling of returns on the other hand, is that it's an even philosophical question, and it touches the philosophy of science. The first one is an approach in which you actually explain what is happening within the economy and within each investor. You're explaining the process that results in a certain process. And this is a normative approach. You are trying to explain how prices are formed, which process is running this, which economic rationale is driving stock prices. For example, because stock prices are high or low because every investor has certain beliefs about future dividends. The other approach, the direct modeling of the returns, or by the use of a factor model, is more of an empirical one. It's more of a positive model. it doesn't want to explain what drives stock prices, it wants to explain the behavior. It simply accepts the empirical behavior of prices and tries to find the best model that fits the data. And this is a positive approach and in contrast to a more normative approach. In many cases, you will also find this as or under the keywords of structural model versus reduced model. The first one is a structural model because it wants to find the economic structure that drives this economic process. In a reduced model, you're not interested in the process driving prices, for example. You simply want to find a model that fits the prices best and that seems to explain this behavior the best, even though you do not have ex ante idea what this process actually looks like. So you have reduced and structural models. Now, stocks are quite simple. You simply take a stock and you try to model the stock prices, you try to model the returns, or you use a factor model, or you get a forecast of the dividends, of the future dividends, and you calculate the prices and the future prices by a present value approach. Now let's next turn to interest rate instruments, so-called spot interest transactions. And the main feature of interest rate instruments is that these securitize the right to one or more fixed or variable cash flows at future dates. And in many cases, we'll simply talk about fixed income products. Fixed income products are simply financial securities that pay off a fixed amount of money, a fixed interest rate. First, let's make sure that everyone is on the same page here. What is a spot market? A spot market involves transactions that take place on the spot. So if I were to buy 1 ton of steel or 1 barrel of Brent oil right now, with immediate delivery and immediate payment, I would do this on the spot market. In contrast, if I want to buy a barrel of oil right now with payment and delivery in the future, but price fixing today, this would be a forward or a future contract. And this will also be one of the first types of derivatives we'll see today. But this here is a spot market. We are agreeing on a contract and we are buying today, and payment starts today. Now, next we can distinguish capital and money markets. Money markets are usually the ones on which securities with a maturity of less than a 1 year maturity are traded, and capital markets have a longer maturity and a maturity of longer than 1 year. So these are capital and money markets. Then let's start with a Zerobond. What is a Zerobond? A Zerobond, as you probably all know, is a security with one single cash flow at the end at maturity. So the nominal amount N will be repaid at the end of the term of the Zerobond without any interest payments, any coupons. That's why it's called zero coupons. The coupons are all zero. And the cash flow of the Zerobond is given by cash flow at maturity, capital T is N. So we have to pay a price P 0,0,0,0,0 N. In many cases, you've seen this in other lectures with N being standardized to 100. So you'll have a price minus P 0,0,0,100. In fact, in financial mathematics, it's often standardized to 1, because in this way, the price of the Zerobond will be equivalent to what? The discount factor that is associated with a spot rate over, for example, 4 periods. And if you know this, you will understand why in financial mathematics we will never use interest rates. we will always use Zerobond prices. Arbitrage-free Zerobond prices that are being multiplied with, for example, cash flows, and you now know that this is actually discounting. You know? Instead of using a discount factor, you can simply use the arbitrage-free Zerobond price, which is the same. If the notional is standardized to 1, so in this case, for example, here we would get something like this, and this is then the discount factor. So this is a Zerobond. The value of the Zerobond is calculated by taking the notional, and if you have interest rates at hand and you want to calculate the arbitrage-free price, you would need to take the Zerobond price, BR, from small t to capital T, and this is the discount factor that is associated with the remaining maturity, the remaining term, capital T minus T. So this is the remainder of the maturity, and by multiplying the notional value with the Zerobond price, you get the arbitrage-free price of the bond, of the Zerobond. And you can see, actually, if the notional is 1, well, it's quite simple that the prices should be equal. Okay. Now, we're making one simplification here. In this notation, we are assuming that there is a fixed interest rate R. In practice, of course, this will never be the case. We will have we will have interest rates that change that with maturities. For example, 2% for 1 year, 3% for 2 years, and 5% for 20-year maturity. However, this only makes it more complicated, and we would have to substitute the interest rate by a function in, for example, the remaining maturity, and this would not change anything else we're discussing here. It would only complicate things, so we'll just assume that the interest rate is fixed at level R. Okay, now the fair value of the Zerobond depends exclusively on the interest rate R. Conversely, from the real price of the Zerobond, you can calculate the internal rate of return, the internal interest rate, and as a sole risk factor, we thus have the yield to maturity or the internal rate of return of the Zerobond. Pardon these slightly off translations. It's the internal rate of return of the Zerobond. Okay, Zerobond. You probably knew what a Zerobond is, but let's see how you do with a floater. What is a floater? A floater, or a floating rate note, is a security whose cash flows are variable interest payments with repayment at the end of the term. And the variable interest payments refer to a reference interest rate that is observable on the market, for example, the 6-month LIBOR, as long as it is not currently manipulated by a large bank, right? So let's assume we have a 6-month LIBOR, and the floater pays the 6-month LIBOR every quarter, every year, for example. Now, the variable interest is determined at the beginning of one interest period according to the then applicable reference interest rate, and we call this the fixing. So how does it work? Assume that the interest rate is paid out every half year, every 6 months. And the next payment is due on the 1st of July. So what will happen is, on June 30th, 1st, we'll get the last interest payment, and on July the 1st, we'll fix the interest rate that will be paid out in December at the end of the year. So for half a year, we know what the interest rate looks like, this next fixed interest rate payment looks like, but we don't know how it will look like in 2019, 2020, and so on. So the fixing is done one period before payment, and we'll see that this actually makes things much, much easier. Okay. And in addition to the variable interest rate, a so-called spread or quoted margin can be agreed upon as a premium for default risk, if you want to include default risk. There are several types of floaters around. Money market, capital market floaters, cap and floor floaters, mixed floaters, collars or so-called collared floating rate notes, reverse floaters. You can see how they work. Quite interesting is, I think, the reverse floater. You don't get paid the LIBOR, for example, but you're getting paid 10% minus the LIBOR. So the mechanism is the complete opposite of a floater. You're not profiting from an increase in the interest rate, but you're actually profiting from a decrease in the market interest rate. That's a reverse floater. Let's try to come up with a valuation, with a price, with an arbitrage-free price of such a floater. We assume that we are at time t, with t being t0 and t1 and then t2 up until tn, which is maturity capital T. The cash flows of a floater are then given as follows. The interest payment that has already been fixed is, see, fixed interest at t1 is the discount factor for the period t0 up until t1 and we're not using the bond price itself, but we take it to the -1th power. -1, so if you disentangle this, you will see that actually this is just the interest rate. We are just taking 1 over 1 plus r to the t power and revert it back to the interest rate. Times n, the notional. For all future, at all future periods, and in all future periods, we'll have the variable payment. We'll take the notional times, and now we have the forward rate going from ti -1 until ti, but that has been fixed today, and this is the forward rate. We can differentiate between two types of interest rates. The first one is the spot rate. The price for €1 today for a certain period of time. And the forward rate is an interest rate that is being paid today or fixed today, but for giving credit from t minus I up until t in the future. So we are agreeing on an interest rate for capital that is being given in the future over a certain amount of time. And this is the forward rate here, BR TI -1 TI, conditional on the time t. Again, we are extracting the interest rate from the discount factor. And if you have seen this in the investment classes or maybe in the introduction to finance, there's a simple relation between the spot rate and the forward rate. To calculate the spot rate from the forward rate and vice versa, you simply have to see that this is one spot rate, this is another spot rate, and if you want to get the forward rate agreed upon here for this period of time, you simply take spot rate TI -1 over the spot rate TI, and you get the same forward rate. So this is how spot rates and forward rates are interrelated. But at this point we can see that we have no clue about the future forward rates. We don't know how the LIBOR will look like in 2, 3, 5 or 10 years. And at this point one could assume that it is not possible to value a floater because we don't know how these future interest rates will look like. Well, guess again, it's quite simple. Look at the final payments, you have the notional, so the present value. If you take the present value approach and we try to value all three different types of payments, we'll see that the first payment is just the fixed interest rate payment. We know this is a given, times the discount factor. Next, notional times forward rate. And we can see actually that if we take notional times forward rate times the discount factor, this looks like this here in line 2. And then finally, the notional is discounted by using the spot rate for n periods. And now what happens is, if you take this here, this expression, and you write it out, you first see that this is actually this here. The difference between two spot rates. Again, we don't know how these spot rates will look like for the LIBOR in 5, 10, or even 2 years. But if you write all those sums out, you can see that this sum is actually BRT T1 minus BRT T2 plus BT2 BRT T3 plus and so on. And what happens is you have, let me simplify it. You will have this, and what you can now see is that this and this is the same, this and this is the same, and so on, and in the end this and this vanishes, this plus this is 0, this plus this is 0, and you're only left with the spot rate, BRTT1 minus BRTTN. Okay, that helps. Now, if you include this again here and insert this here, you can see that the present value is given by fixed interest payment times the discount factor with the first fixed interest rate payment plus the notional times BRTT1 minus BRTTN plus the notional times BRTTN, and again this and this here becomes 0. And you're left with BRTT1 times n plus the fixed interest payment, or this here. So in the end, the present value of the floating rate note is the sum of the notional amount and the already fixed cash flow discounted at the spot rate on the next interest day T1. So a floater is nothing but a 0 coupon bond with a nominal amount or a notional of n plus this fixed first payment that is due on the next payment date. And this is the surprising result, that even though you have no clue about the variable interest rates in the future, and this future might run for another 20 years, for valuation it doesn't matter. And why is this the case? Well, actually, if market interest rates increase, so will the interest rates with which you are discounting. And every euro you earn from this floater will also be spent at the same time on discounting. And these differences will be all 0, and in the end, the floater is nothing but a 0 coupon with a higher notional. And for valuation, this is very simple. Now, we haven't so far considered a credit spread, K, but this is quite simple. You simply need to include this credit spread, which is an add-on to your interest rate. And how would you do this? You have a long position in the floater with spread K, and you duplicate it with a portfolio consisting of a floater long without spreads, for example, a LIBOR flat, that's how it's called, a coupon bond long with a spread as a coupon and the notional value, coupon date and maturity of the floater, and a zero coupon bond with a nominal value and maturity of the floater. Now, is that clear to everyone how this works? Especially the combination of a long and short position. So you're buying long and you're short selling the short positions, and you can duplicate a position in the floater with a spread. So you would have to pay minus P, you would get variable, 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 and notional. Now let's include and it's quite clear how you can construct this. You take a floater long without the spread, so variable, 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 and plus variable. So this is done, this is done. A coupon bond long with a spread as coupon and the nominal value of the floater, so K, 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 N plus K. And a zero coupon bond short with the nominal value maturity of the floater. So minus 0, minus 0, minus 0, minus N. And if you now combine these three, the sum will be V plus K, V plus K, V plus K, N plus V plus N plus K minus N. And then this will be gone and this will be 0. And you see, you get the floater with a variable interest rate and an additional fixed credit spread on top. And this is how you duplicate, for example, a more complex financial instrument from just the set of basic linear assets. And with a short zero coupon, this double repayment of the floater coupon is offset. And this construction, this idea of separating the repayments of the bond, this is also sometimes called stripping. If you want to take the variable interest or the fixed interest rate payments out of the bond, and you are in fact not interested in the notional, you can do this by stripping the bond, by stripping the coupon payments from the bond, by adding a zero bond in a short position. This is called stripping. And of course, this is valuation via stripping. So, and here you have P1, P2, P3, and then P1 plus P2 minus P3 should be the price here of this floater with a credit spread on top. Now, as we've seen, the floater is, in terms of valuation, nothing but a zero coupon bond. Therefore, either the spot rate or the yield to maturity of the floater can be used as risk factors. So again, in case, of course, we use an additional credit spread, we might have a second risk factor. But assuming that we don't have a credit spread on top, the only risk factor is the yield to maturity, the interest rate, and the spot rate we use for discounting. Well, next very simple asset is a coupon bond. What is a coupon bond? A coupon bond, or in many cases we'll just call it a bond, because this is the standard case, the most default case. The Zerobond is more a special case. A coupon bond is a security with a so-called coupon that determines a fixed interest rate K. Cash flows from interest payments of a coupon bond are equal to the interest that the notional amount N bears with the coupon interest K over the relevant coupon period. And we can see that we have a repayment of notional value N at the end, and we have payments notional times the interest rate that is being paid on the notional. And for example, we say that the bond has a 5% coupon. So this is a standard bond, and discounting the payment series and the cash flow series with a reference interest rate gives us the present value of the coupon bond, just like it has given us the present value of the floater for the bond. It's even simpler, and as you can imagine, this is the standard fixed income product. Fixed income because the income you get as an investor is fixed, as you have fixed interest payments. Reference interest rate or year to maturity is again the only risk factor here in play. And if you want to model the losses from this investment, you would just have to take the interest rate from the market, the spot rate. Now let's make it a little bit more interesting. Let's turn to interest rate swaps next, or just swaps. What is a swap? A swap is usually an OTC contract for the exchange of interest payments. In the simplest form, the plain vanilla interest rate swap, fixed interest rates are exchanged for variable interest rates. So depending on the type of fixed interest payment, you have either a payer swap or a receiver swap. And these can all be held long and short. So this is a swap. For example, a long payer swap that is also equal to a short receiver swap, or just a long swap. A long swap is we pay fixed interest and we receive variable interest. So always remember that if you buy something, if you buy a payer swap, you are buying the variable interest payments. You're interested in variable interest payments. So this is what defines the definition of a payer swap against a receiver swap. Now, a short payer swap, a long receiver swap. The long receiver swap receives fixed interest payments and pays variable interest. A long payer swap can be understood as a portfolio of a short coupon bond with the interest rate of the fixed side as coupon and a long floater. So you can see that even though this is a more complicated financial instrument, valuation is actually quite simple because you have two legs, we call them two legs of the swap. We have one leg that received and one leg that pays fixed interest payments. And one is a coupon bond, the other is just a floater. And if you know this, you can combine the present value of a floater and the present value or the price of the coupon bond, and the difference will be the value of, for example, a long payer swap. This case here, it's just the price of a floater minus the price of a bond. You're getting the variable payments and you have to pay the fixed payments, so you are interested in the price of the floater and you have to pay the price for a bond, of a coupon bond for this one. Now, you have to be this is already an example of a very simple financial derivative. Why? You can see that a swap is a contract in which the price of the swap depends on the price of two simple financial assets, some two linear assets. It's not very complicated, but one could argue that a swap is already a financial derivative. It's not an option, but it's a derivative. You can see one defining thing about a swap contract, about a financial derivative. Financial derivatives, in contrast to basic, simple linear assets, derivatives are always in zero net supply, and they also always pose a zero-sum game. Can anyone explain that to me? Why is a financial derivative always a zero-sum game, and why are they in zero net supply? Yeah? Zero-sum game. zero-sum game, and this is true, I would assume, with all financial derivatives, for all financial derivatives, it's always a zero-sum game. Someone profits, someone loses. If the long position profits by €1, the short position will have a loss of €1. Not more, not less. This is interesting because one always has to consider this fact when reading something about the black magic of financial derivatives in the media, because again, it's a zero-sum game. So if someone loses in a play with the derivatives, someone else makes a lot of money, and actually not more, not less, but just the same amount of money. So every euro that is spent on a financial derivative is actually earned by someone else. It's different with, for example, stocks. You can have a stock, and if supply and demand change, the price of the stock may increase, it may decrease. If the underlying fundamentals change, if the profits of the companies change, the fair price of the asset might change, it might increase, and actually your position might appreciate in value. So it's not a zero-sum. And why are derivative markets always in zero net supply? Imagine this were the financial market here, an empty room. Well, not empty, but let's say it were empty, and now suddenly people come in, but they don't have any financial assets to trade. They're just a room full of traders. What happens if we start trading in derivatives? It's a very simple picture you have to paint. With stocks, I could take out a sheet of paper, I could say I'm now giving out stocks of my company, I could throw them into the room, and if no one's interested, they would just be lying around in positive net supply. So if you subtract, if you take the difference between supply and demand and the difference between long and short positions, you would see that actually there's a positive net number of stocks lying around in the market. Then someone else will buy them, and the number of stocks will not change. They will remain positive. Because even if someone takes a short position in the stock, the net supply will always be positive. Now what happens if we start derivatives trading? If we start, for example, a swap contract. I would say I want to enter a swap contract in a long position. And then I need someone of you to enter the same contract as the counterparty with a short position. So for every long position there is always exactly the opposite short position, and all short and all long positions, if they are netted on a derivatives market, will show you that all derivatives markets are in zero net supply. So for every long, there is always a short position. This has fundamental consequences in asset pricing. And one of the most immediate effects is that, for example, liquidity in derivatives markets has a much more obscure role than in, for example, equity markets or bond markets. Why? Now, if I produce stocks and they are in positive net supply, I know that in the worst case, the stocks will simply be lying around in a portfolio and no one wants to buy it. So this is the worst case, meaning that I will always pay a price for liquidity. And this is the result of the Acharya-Pedersen liquidity-adjusted capital asset pricing model in the JFE paper in 2006. Liquidity comes at a price. It's something good. The higher the liquidity, the better the opportunities to quickly resell the stock. But what happens in a derivatives market? Now both parties might want to go out. Remember, I have a stock. I am the owner of the stock. Then liquidity matters to me. And if I don't have a stock, and I don't want to buy it necessarily, I don't care about liquidity. So if I'm the owner of the stock, it's quite clear that the owner of the stock is always interested in high liquidity. Now, in a derivative market, where you have long and short positions, and long and short positions always match each other, it's unclear whether the supply side, the long side, or the demand side and the short positions have a stronger influence on market liquidity, and the effect of liquidity on prices in derivative markets is much more unclear than it is in markets with positive net supply. That is a result, I think, from 2011, in a Journal of Finance paper by Dion Bongartz and, oh, shame, I've forgotten the other names. 3 Dutch researchers. Dion Bongartz and 2 other colleagues, I've forgotten the name, but if you Google Bongartz et al., Bongartz being Bongaerts, Bongartz, you will find it in the Journal of Finance. Okay, so this is already a financial derivative, and a swap contract, you can see these defining features of a derivative here as well. For every long position, there has to be a short position. You cannot simply sit idle on a swap with no counterparty. There's always a counterparty, meaning you always have counterparty risk. If you enter a swap contract and the counterparty defaults, well, no one will give you that coveted fixed or variable interest payment. You were counting on it, but you will not get it. Valuation is quite simple here. And of course, you can now generalize the idea of swap from interest rates to many other market prices. You can come up with different swaps. With what underlines could you agree a swap on? Interest rates, that's a given. What else? Next, easier example, yeah? Currencies, foreign exchange swaps, FX swaps. Simply exchange a variable exchange rate with a fixed exchange rate. Next example, commodities, energy, trading. Simply exchange, for example, a fixed price for a variable oil index or a natural gas index. Take NCG, natural gas index, and you can fix the price for oil or gas. And you can see why a swap is usually the most useful tool you have in risk management. And if you ever see a risk management department of a large trading company, a large bank, but especially in energy and utilities, in the utility sectors, they will all go for swap contracts with institutional investors. They will see that they have an exposure to, say, a Brent oil index or NCG gas index at certain hubs, and they know that they will profit or make a loss depending on increases or decreases in this variable index. So what they do is they fix the price by using a swap contract, and you have to imagine this just as I've just described it to you. Take, for example, a large energy company. The large energy company will do what? Might not do this today, but a couple of years ago it did exactly this. It buys large amounts of natural gas from Russia via Gazprom. It has long maturity contracts and long-term contracts with the Gazprom or Rosneft, the large energy companies in Russia. It will get the natural gas to Germany, to Europe, and then it will sell off the gas with a so-called oil price formula. Meaning, traditionally, natural gas is sold as a function, with the price being a function of certain indexes. And these indexes, for example, being NCG oil or Brent oil. And the price of the natural gas being related to the price, the market price for oil. So the price for gas will look like this. Actually, I don't know the English abbreviation. Actually, no, this is the English abbreviation, right? megawatt hours. The natural gas is not measured in volume. Why? Because its volume changes depending on the temperature. And the way you measure natural gas is via its energy value. And that's, for example, megawatt hours or gigawatt hours. So 1 megawatt hours of natural gas, and also there are differences from types of gas to the next type. So if you take gas from Russia and compare it with natural gas from the North Sea, it might have different energetic values. So it's best to measure the energy. So you have this amount of energy, and you would say that it costs 0.3, let's make it euros, plus, for example, 0.05 times Brent oil index, plus 1.1 times NCG. So every megawatt hour you are selling earns you a certain price, but the revenues you are generating depend on the level of those two market indexes. Meaning that on your supply side, you have a fixed cost, but when it comes to revenues, your revenues are highly dependent on the changes in the market indexes. Now what do? You look at the market indexes, and if they have a good level, you simply agree on a swap contract with an institutional investor and simply fix your revenues at a certain level and swap the variable revenues you have in Brent oil and NCG for a fixed income. And you will simply go to your risk manager. Your risk manager will calculate how much risk exposure you have against Brent oil or NCG. This is more complicated in practice, of course, because we are not talking about one contract. We are talking about thousands and thousands of different large-scale contracts, and we are talking about gigawatts and 30, 40, 50,000 gigawatts hours of energy being traded, and a number of 12, 14, sometimes 15 indexes, and you have to net all those effects, because in some cases the formulas are more difficult, and you might also have variable contracts on your supply side, meaning that your costs are not completely fixed, but also depend on those indexes. And if you know that you have exposure of, say, 5,000 tons barrel, or no, 5,000 barrels oil, but on the plus side, and you have minus 3,000 barrels minus, you can net this exposure, and you see you only have a net exposure of 2,000 barrels of Brent oil. And then your risk manager will tell your trading department, we need to hedge the risk of 3,000 tons of Brent or 3,000 barrels of Brent oil. They will do a swap contract. They have energy trading companies, investment banks, asset managers standing by, and they will agree on a swap contract. And this is one part, for example, investment banks do. But also in this part, in energy trading companies. They are also specialized on these types of contracts. Okay. So valuation is actually quite simple for a swap. Valuation is done by taking the two legs of the swap contract and valuing each leg separately, and you see it's floater plus a cube, or no, floater minus 1. Now, you could also model the default risk, but we've already seen this. You would simply include an additional credit spread K in the valuation of the floater or the bond, and then it's a little bit more complicated, but this could be done here as well. And the question now is, what happens if the counterparty's risk changes? We've assumed that this credit spread is fixed, its K is fixed. Now, if default risk changes, of course, one would need to use adjustable credit spreads K minus K1, K2, K3, or something like that. Okay, next, a forward rate agreement. What is a FRA? A forward rate agreement is an over-the-counter contract in which a fixed interest rate K is agreed upon between the two parties for a capital transfer of the notional amount N for the future period capital T to capital T dash. The forward rate agreement can be seen as a future loan whose interest rate is already fixed today. And unlike the bond, the position of the party receiving the amount N is called long, and the position of the party receiving the fixed interest rate is the short position. Now, how can we find a price here? Now, the cash flows of this unconditional instrument, remember that this is not conditional on any decision any party can make, but this is unconditional. Every party has to stick to the original plan laid out in the contract. It's relatively simple. A long forward rate agreement involves the incoming party, an incoming payment N at time T, and an outgoing payment in T dash at the notional amount, compounded with the interest K. So the present value of a forward rate agreement at time T is given by the notional times the discount factor from small t to capital T minus the notional amount over BK times BR from small t to capital T dash. Again, we can change this a little bit and we see we can write this with the forward rate and the spot rates, and once again we can see that the interest rate structure, the yield term structure in the form of the spot rates and the forward rates is the only thing we need in terms of risk factors. Again, this is a very simple interest yielding and interest bearing financial instrument, so it's no surprise that we only need the spot and forward rates to come up with an idea of what the price should look like. So we need to model the interest rates. Next, an interest rate future. For this, we define a contractual agreement to buy or sell a standardized interest rate instrument in the future at a previously agreed price. So again, it's an unconditional contract. We agree to buy it, whatever happens. Unless we default, but we cannot change the contract. So zero coupon bonds or coupon bonds, for example, can be used as underlyings. Then we have a future contract on a zero bond, or a future contract on a coupon bond. And the valuation of these futures usually includes the determination of the difference between the forward price of the underlying and the strike price or the exercise price. And we also have accrued interest that plays a role in the valuation. That is the compensation payments for accrued interest claims on the coupon bonds. So we also have forward swaps. A forward swap is simply a contract in which we agree to enter a swap contract in the future. So the swap doesn't take place right now, but it only takes place in this period from capital T to capital T dash, and both points in time are in the future. So this is a forward swap. Very simple. We can also use a forward bond. Okay. And these are slightly more sophisticated variants of simple fixed income products. However, they are all still linear assets, and they only depend on changes in interest rates, meaning that this is quite simple for valuation and very simple for risk management. Now let's turn now to financial derivatives, options. And you might have seen this. Let me do a quick survey. Who of you has already taken the class on derivatives? Just 2, 3, okay. So what is an option? What is a financial derivative? We'll talk about this here. We'll continue talking about this in the computational finance module in the master's degree. But what is an option? What is a financial derivative? First of all, a financial derivative is a financial asset whose value is derived from an underlying securities price. So we have an underlying contract, and the price of the derivative is derived from the underlying price. That's why it's called a derivative, German Finanzderivat. The most important example is a plain vanilla option. What is an option? An option is a security, is a financial derivative, more precisely, that certifies the right to buy or sell a certain underlying at a later date at an agreed price. It is therefore a conditional transaction in the future. Why is it conditional? It's conditional on the buyer saying, I want to exercise the option. He can also leave it alone, in which case the option expires. So this is the main difference between a future or a forward and an option. In the option you have the right but not the obligation to do so. Physical delivery is usually not required. You do not need to physically deliver the underlying. What you simply do is you take the difference between the exercise price and the current spot price of the underlying, and you do cash settlement. You simply take the difference in prices and you pay out the difference in the prices. Now, an option is called European if the option can only be exercised at the end of the maturity, an American option if it can be exercised at any time, or a Bermudan option if it can be exercised at certain points in time over and over again. So, for example, on each first day of each month. Then it would be a Bermudan option. It cannot be exercised on the second, third, or so on. It can only be exercised on the first day of a month. That is a Bermudan option. Why? Because the Bermudan Islands lie right between Europe and America. So, European, American, Bermuda option. In fact, Bermudan options are close to being an exotic option. We can then distinguish between call and put option. Call option is an option in which you have the right to call to buy the underlying. The put option is the right to put the underlying on the market to sell it. Kauf-Verkauf-Option in German. And one way to differentiate between all those different types of plain vanilla options is the payment profile of those options. Let's start with very simple European call options. We refer to ST as the price of the underlying at time T, K as the strike, and capital T as the term or the expiration date of the option. And then a long position in the option at maturity, at the end, when it can be exercised, is the maximum of ST minus K or 0. Why? In case ST is lower than K, I'm not exercising the option, and the value will be 0. And in case the stock price is higher than the exercise, the strike, then I will exercise the option, meaning the difference is my profit. And for the European put option, long position, it's the other way around. Now, these are plain vanilla options. Let's now turn to the first set of exotic options. Exotische Optionen. Exoten. What are exotic options? A power option, for example. A power option is an option whose payout is given by powers of T, ST, or K. So, for example, we can use this asymmetric power call, which is the maximum of 0, ST taken to the nth power, minus K taken to the nth power. And this means that you're not just earning the simple difference between the stock price and the strike price, but you have to take it to the nth power. Asymmetric power put, the same. Symmetric power call. So we have 0 if the stock price is lower than the strike, or ST minus K, and you now take the whole difference to the nth power. And you have a self-quantum call, which is ST times the maximum of 0 times ST minus K. So you multiply this difference with the stock price itself. Now a question for you. If these exotic options, obviously have a much higher payout in case the stock price is higher than the strike. Why would you not always buy, for example, a Zerobonds call, which is the highest payout? We haven't talked about the option price, right? We haven't talked about the prices of these options. And these options will have a much higher price than a generic plain vanilla option. So these are just the payout profiles, the cash flows you will receive at maturity if you exercise the option or not. And we haven't talked about pricing. That will be done next, in the next lecture. Next, a click-it option. What is a click-it option? It's an option with several exercise dates at which the strike is reset to the currently valid underlying price, and this is what we call a reset. Payments are made either directly or compounded on the last due date. So a click-it call, for example, is the maximum of 0 st dash minus k discounted, oh no, it's compounded, plus the maximum of 0 st minus st dash. And this is just a click-it call in which we have one reset timing, and at this point of time, the strike is reset to the current underlying price. This is why we have a strike K in the first term and a strike ST dash in the second. And this is another exotic option. Cube option is an option with several exercise dates at which the strike is reset to the currently valid underlying price. That's the same as with the click-it option, or the original strike K and the new strike that is less favorable for the option buyer is selected, meaning that the click-it option is always better than the cube option when it comes to payout profile, because it's virtually the same. We only have one more restricted rule with which we can, with which we are selecting the new strike. And here, down below, you can see the formula for the cube call. What is a look-back option? A look-back option is an option in which the holder has the option to choose the price of the underlying or strike from past values so that its payout profile is optimal. It works pretty much like power calls. So a minimum strike call is ST minus the minimum strike price you've seen over the whole period of time. Maximum strike put is the same. A look-back spread call is the maximum of 0 and the maximum of ST dash minus the minimum of ST dash minus K. And again, these payouts are much, much higher than for a plain vanilla option, meaning that their prices should be higher as well. There is one striking difference now between this option and the other types of options we've seen so far. And this feature makes these options truly exotic in comparison to plain vanilla options. What is that? And this is actually what defines more or less what plain vanilla options are. Imagine the stock price starts here. We can exercise the option here. And this here is the strike. Now the stock price may go here. Then we will have to look at this difference. Next, assume that the stock price goes here, and we have to compare this difference. In both instances, we only have to compare points and prices here, 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 or here at time t, at maturity. But if you now look at a look-back option, the payoff in capital T depends on this minimum, on this maximum, on the path of the underlying price. And this is why we call this a path-dependent option. Pfadabhängige Option. Because its price is depending on the path the underlying price has taken in the past. Same with Asian options. An Asian option is an option at which the strike or the price is given by an average of the underlying price. So you take the average of ST dash. Again, we have a path-dependent option. And you can also now define numerous other types of options. For example, rainbow options. A rainbow option is an option at which the payout profile depends on the relation between several underlying. For example, you're getting a payout, the difference between the Daimler and the BMW stock. That is a rainbow option because it has many different underlyings in it. You also have compound options for which the underlying is itself an option. You have digital options for which the payment is independent of the underlying. For example, you could simply say, if this is the strike, stock price is above €1, if it's below, 0. So this would be a digital option. It only pays on €1 regardless of how large this difference is. If the stock price is higher and you buy a digital option, you get €1. In this case, the option would be much, much cheaper than a plain vanilla option, than a European call option. And you can also define so-called barrier options, and these are distinguished and differentiated into knock-in and knock-out products. A knock-in product is an option that only becomes valid after the underlying price has crossed a border, has crossed a barrier. And then afterwards, it's active. It has been activated and it can be exercised. A knockout product is the other way around. It's already active from the start, but it is being knocked out if the underlying price crosses a certain barrier. If it loses too much, it will never recover because it's knocked out. And these are called barrier options because you have an upper or a lower limit for the underlying price. Okay. Any questions? So you now know all about very basic valuation of linear assets. You know that in many of these cases you only have the interest rate or the price itself to model in order to get the loss distribution. For derivatives, we at this point only know the payout profiles, which can be quite interesting from option to option. We've already seen that there are fundamental differences between those option types, and we have to distinguish between plain vanilla and exotic options. And exotic options usually meaning that they have a more complicated payout profile and are usually path dependent. Knocked out means knocked out. Because if it can be knocked in again, it would just be a regular, general, plain vanilla call option. That's the fundamental difference. For valuation, actually, barrier options are quite simple. You can get an analytical solution from the Black-Scholes model. And we'll see this next time. Valuation will be done on one of the most famous and fundamental models in finance, the Black-Scholes model. And we can distinguish between two types of derivatives. The first type of options, for this type of option, the Black-Scholes model will give you an analytical solution and we'll get a pricing formula. And if the payout profile is too complex and it's too complicated, the Black-Scholes model will give you a formula and an equation that cannot be solved analytically. And we have to use computer resources, we have to simulate numbers, and we need to get an approximate solution. And this is how we define plain vanilla and exotic options. Every time we can use the Black-Scholes model and we get an analytical formula, so a formula into which you can simply put the numbers in and get the option price. These will be plain vanilla options, and every time the Black-Scholes model does not have an analytical solution, it's an exotic option. And we'll see this next time. Any other questions? If not, thank you very much for your attention, and see you next time.